Today about average cost or WACC. This topic is the most important topic in your CT2 paper. The reason weighted cost of capital involves both a theory and a practical one. We will discuss in detail that is cost and various sources of raising funds for any organization. Primarily, sources of funds can be classified into two: first, debt, other one being equity. Debt and equity. That is the source of fund or that of fund which an organization borrows at a particular cost. Say for example, if I say the company has borrowed 50,000 at 8% per annum. This that the company has borrowed a sum of 50,000 and will 8% interest annually. Is the cost which the company has to pay. Now, in which the debt can be borrowed. These are borrowed from the bank, by overdraft or any other facility with bank, or the way of issuing debentures. The fund by way of facility provided by the bank or by issuing debentures. In this case, the company has to pay certain amount of interest. If it borrows the fund from the bank, it has to pay. Say, for example, the company has borrowed a fund of $50,000 and interest of 8% per annum, or borrows the fund by issuing debentures and pays the interest at the rate of 8% per annum. By computing the cost of capital or the weighted average cost of capital, we need to first compute the cost of and the cost of equity. Now, the cost at which the company borrows the fund from the banks or financial institutions or by debenture to the ordinary public, which are the real owners of the company, that is, those persons who have purchased the common stock or the equity share capital of the company with their money, are the real owners of the company. Now, it always expect certain amount of return. They expect certain amount of return, and the expectation is cost of equity. This which I have started giving you about the cost of debt and the cost of equity. Compute the cost of and compute cost of equity. In terms, cost of is the cost which if the company borrows the fund from the financial institution or issuing debentures. On the other, cost of it is the expectation. Mark my words, it's the expectation which the shareholders of the company, that is, they expect that the company should earn certain amount of return. This is known as cost of equity. There are modes by which we can compute the cost of debt and the cost of check out the various modes of computing the cost of equity, various ways of the cost of equity. Generally computed by two models The one very popular model in finance, which is known as CAPM, or asset pricing model. Most recognized or well-recognized models seem to be based on a very reasonable and clear by which we can compute the cost of equity, model which is known as dividend discount model or DCM. The model was propounded by Gordon and then known as Gordon model. Now, what capital asset pricing model talks about how to compute the cost of equity. A simple formula, that is K is equal to RF plus minus RF in beta. Now, what we know is the cost of equity, that is the expectation or the expectation has for investing the money into the business of education, cost of equity. RF rate of return is the risk-free rate of return, that is the return which the investors at any given point of time. That is the risk-free rate of return which an investor can earn at any point of time. Generally, RF is taken to be the return which is generated or return which is provided by a government security. Generally taken to be the return of government security. This is because government securities are considered to be risk-free. Risk-free in the sense there is zero chance of default by government. Hence, the risk-free rate of return is generally taken to be the return provided by the government security. RM is the return of the market. Market here, the return of the market. Market here is taken to be the market is taken to be the index. Like for example, say in India we have Sensex. These are the index. The return provided by the index is taken to be the RM or risk return from the market. Now, the idea or the concept behind the calculating CAPM by calculating cost of equity by way of CAPM is that investor can at any point of time risk-free rate by investing his funds in government security. Because if he is investing his funds in other business or in any other organization, then he will give a certain amount of risk premium. Now, this premium is on the amount of risk or the degree of risk which an investor takes by investing his funds into the business of the company. The risk premium is the proportionate additional amount which an investor would expect to obtain by investing his funds in the business of the company. Talking further about the risk premium, we should discuss about the beta. Now, beta is generally the measure of there are two risks which one has to face when he invests his money in a particular kind of security. The other one being unsystematic. Systematic risk and unsystematic risk. Come back to the point of cost of computing cost of equity, cost of debt, and then computing weighted average cost of debt. But talking about anything about cost of equity, we discuss about the different types of risk which an investor invests his money in a particular security. There are two risks which an investor faces when invests his money in a particular security. This is systematic risk and unsystematic risk. What is systematic risk and what is unsystematic? Unsystematic is the specific risk organization that an investor pays when he invests money into a particular security. For example, if the person invested money into a particular risk of their Reliance, he invested money into the stock of Reliance, he has to pay about the risk which Reliance pays due to operations. However, unsystematic risk is the risk which an organization has to face due to operations. Has its own operation, own methodology of doing the work, and due to it has certain amount of risk. This is known as unsystematic risk, which is stock specific. This is stock specific risk or unsystematic risk. Again, another risk is systematic risk. Systematic is a risk which is in cases which a person has to face irrespective of the fact whether investing his money into Reliance or investing in other company. These risks are generally to the macroeconomic factors such as inflation or government rule or any macroeconomic factors. Macroeconomic factors here mean the example of this regulation due to which all the company has to pay amount of burden. This is again for the company has invested, so the company is doing its operation, and due to the change in regulation, its profit might deteriorate. This is the regulation, but this is not in the hands of the company because it is dependent on the operations of the company. It is dependent on the regulation which are set by the government, and so all the companies which are in a particular industry or in the market. Thus, risk is common to all stocks. Investors cannot avoid systematic risk, whereas unsystematic risk can be avoided. CAPM is based capital asset pricing model is based on the belief that an investor can avoid unsystematic risk if he diversifies his stock. Why dedicate to the diversifying his stock? Because, say for example, if a person is investing all of his money into the stock of Reliance, and due to the operations of Reliance, the stock falls dramatically. The stock has fallen. They lose nothing. But now, an investor pulls a portfolio wherein he has invested his money equally in 10 stocks in the market. All the 10 stocks cannot perform badly at a particular point of time. Might be that one stock is performing very good, one stock is performing average, and third stock is performing bad. So, all average, the performance of one stock will be cancelled by the bad performance of the other. Thus, unsystematic can be avoided by holding a diversified portfolio. I have discussed about the two different kinds of risk, that is systematic risk and unsystematic risk. This is based on the assumption that all investors are rational. That means that if an investor is rational, he invests in a portfolio of stocks and he won't invest all his money in a particular stock. Thus, the investor is never face an unsystematic risk, but always face a systematic risk. Because as I've already stated, systematic risk cannot be avoided, but unsystematic risk can be avoided. Since systematic risk cannot be avoided, an investor has to face a systematic risk. Or a rational investor will not face systematic risk because he is in a diversified portfolio. Now, the topic of cost of equity. how to calculate CAPM, or we were discussing about how to calculate CAPM, or CAPM is calculated as cost of equity is equal to RF plus RM minus RF into beta. This thing is also known as risk. Beta measures the risk is a different systematic risk based on the performance of the market, and thus beta measures the systematic risk of the stock. Therefore, beta can be from various ranges. A stock of greater than 1. Stock has a beta of greater than 1. This means the stock is very aggressive, and if the stock beta greater than 1, this means that the stock is very aggressive. This again means that, say for example, the stock has a beta of 1.5. This means that if the market changes by 1%, the stock will change by 1.5%. Because the systematic risk, it also states that if a stock changes by 1%, if the market return changes by 1%, the stock return will change by 1.5%. If computed by multiplying the beta with excess return over risk period. Another which we can compute is a discounted cash flow or discounted discount model. Dividend. Equity is equal to D1 by P0 plus. Discuss about what is D1, what is P0. Now is the expected for example, today, and the company is expected to pay dividend on 31st 12 at the 10%, or say for example, which is equal to 2. If the investor is expecting that the company will pay a dividend of rupees 2, if company will pay a dividend of rupees 2 at the year end, which will be called as D1. D1 is equal to expected dividend rupees. Is the current price. We know that there will be a certain price for the stock which is known to everyone. That of the stock will be known as P0 or the stock. Both rates. The amount of dividend will not be constant. It is from time to time. The rate in the dividend, that is how investor is expecting that dividend will increase over the time. Growth rate is 10%. Now, growth also, another formula which the growth can be computed is equal to VR. V for retained rights. Now, two things which I would to say here is retained is the amount of net income which the company has retained. For example, if the company earns, or if EPS of the company is equal to rupees 10 and less dividend of rupees dividend share is equal to rupees 2. The retained earnings or the earnings retained by the organization is rupees 8. So if compute B will be 8 divided by 10 into 100, which is equal to 80%. 10% of the earnings was retained by the organization and the rest was distributed as dividend. Now this earning of rupees 8 will be deployed to the business. The company is retaining any amount. It again deploys the same into the business for the regular operation of the company, which generates certain amount of income. Now income will generated retained earning is shown as return on equity. Equity is nothing but net profit return on net profit after tax divided by shareholders' equity. That is the amount of return which the company is generating with the shareholders' equity. In this case, if the retained earnings that we know is 80%, and again the return on equity is 10%, then getting the point. No. So as dividend discount model includes T1, which is expected dividend divided by P0 into P0. If the expected dividend is rupees 2, the current price is 20, and growth rate is 10%, then you compute the cost of. In this case, the cost of equity shall be 2 into 0.15, 20, which is equal to 0.01 or is equal to 1,000. Now, we have that is CAPM and dividend discount model. By using both this model, we can compute cost of equity. Cost of debt. Cost of debt is nothing but the amount of interest which the company has to pay when it borrows the fund. Now, debt borrowed from various sources, like a company can borrow debt by bank loan, or the company can borrow the debt by issuing in the market. It can borrow debt by issuing bank loan, or right. Both bank loans and debentures require an amount of interest paid by the organization. Thus, however, if the company is paying certain amount of interest, it will certain amount of tax. Since interest is the tax allowable, when we compute the income tax to be paid by the organization, interest is allowed as a deduction. Thus, company paying any amount of interest, it will save certain amount of tax. This cost of debt shall be computed net of tax into 1 minus tax. If it's an example, fees tax 10% is 50%. In this case, will be 10% in minus 3%, which is equal to 10% in 1 minus 0.5, which is equal to 5. Right? Now, cost capital, we have discussed about cost of debt and book average cost of capital is market value of debt divided debt equity plus cost equity into value of equity by debt. We have taken market value of equity as the base. For example, our cost of debt is 1 lakh, post tax is 10%, and cost of equity 20%. In this, and that is 10%, cost of equity is 20%, market value of equity is equal to market value of debt is equal to this like is the capital employed. Capital employed, you can say. Value of capital employed. Now, by computing weighted average cost of capital or WACC, 10% multiplied by 1 lakh divided by 4 lakh plus multiplied by 3 lakh by 4 lakh. We computed like 2.5% plus 50, which makes a total of 17.5%. This 5% is the weighted average cost of capital. Now, weighted average cost of capital employed is the objective of any organization is to maximize shareholders' wealth. Shareholders' wealth will be maximized only when the return on the objective of the organization, wealth maximization, can maximize only when the company earns more, the company has a cost. The reward for the company is 17.5%. Now, if the company earns or the return of the company is more than 17.5%, the company will be able to create a holder. Now, return is greater than 17.5%. That is that create yeah. In any chapter, we will follow a three-fold step. In the first step, we talk about the concept. In the step, we will discuss about the concept in detail by way of examples. In the third, we will note down key points so that while before exam, when you start recording chapter, you will be able to understand the chapter entirely. When I write with follow three-step procedure, a three-fold process, which a student can easily understand chapter and required to mark the chapter. And who have to constantly analyze the financial data. To analyze the financial data, one must understand key or the key aspect of the finance, which is why CT2 provides us. The purpose of CT2 is to provide a clear concept of the financial data or the clear understanding of the financial aspect of the financial management. With this